Probably the biggest decision you'll ever make when taking out a home loan is whether to choose fixed or variable. The decision to choose fixed or variable will depend on your financial situation and what your financial goals are. If you choose a variable rate loan product, then your interest rate goes up and down, and so does your repayment. It can also go up and down. The benefit, of course, of having a variable rate product is that there are these loan features that are not available in a fixed rate product. So you can do extra repayments. That means you can actually pay down the loan as soon as you can. So if you know you've got those extra funds or like those disposable income at the end, once you get your salary and you deduct your expenses and you know you'd have a surplus every month, then it's good to consider a variable rate loan product because you can put those extra surplus that you have into your home loan, and that helps you pay your loan faster. With a fixed rate loan product, on the other hand, that fixed rate remains for whichever term that you choose. Let's say you can choose between 1, 2, 3, 4, 5-year fixed rates. There are other lenders that can lend you up to 7 years. And so that rate will remain with you. And that repayment, of course, will be the same for that period of time that you choose. It gives you the comfort knowing that your repayment will remain the same for that number of years that you choose as well. So that's something to think about. So if you're working on a very tight budget and you know how much your income is, you know how much your expenses are, and you know that you can only afford to pay a certain amount monthly or weekly or fortnightly, whichever repayment terms you choose, right? And so if you want that peace of mind, then choosing a fixed rate product is also good. The thing is, with a fixed rate product, you cannot do those extra repayments that you can do when you choose a variable rate product. At the same time, when you break a fixed term before the expiration of that fixed term, what happens is you may be paying a lot of fees. There's like the exit fee, the break cost fee, which you will have to ask the bank to calculate for you. So what should you consider when choosing a variable rate product? First, your repayment goes up when interest rate rises. Number 2, budgeting becomes more difficult when interest rates are rising. And then number 3, when interest rate rises, there's the possibility that you might have difficult servicing your loan. And you don't want to be in a position that you're not able to pay the loan and go into default. That's the last thing that you want to happen. What are the things to consider when taking out a fixed rate? Number 1, you will not benefit from falling interest rates. Number 2, getting out of a fixed rate is very expensive. So number 3, it's expensive because there's the break costs, exit fees that you need to pay. You can only find out once you actually speak to the bank. So let's say you take out a fixed rate term for 24 months or 2 years, and then halfway through, you need to sell the house. That's possibly one reason why you want to get out of the fixed rate. And if you have to sell the house within 12 months of taking out that fixed rate loan product, then of course there are exit costs and break cost fees, which may be substantial. So it's really up to you. It's something you have to make a decision about when the time comes. Number 4, you're not, of course, allowed to make additional repayments, which are available in a variable rate loan product. And then number 5, those loan features that are available on the variable, which are the offset accounts and the redraw accounts, they're not available in a fixed rate product. There are probably I have 2 or 3 lenders in which an offset or a redraw is available. But if this is something that you think will actually work out for you, please give us a call and we'll actually explain these loan features for you. Number 6, as soon as your fixed rate expires, it switches to a variable rate loan product. So depending on what the interest rates are 2 or 3 years down the track, whichever term or set term that you choose, then that's the rate you are getting after the expiration. So before the expiration of a fixed rate, what we normally do is call customers probably a month before the fixed rate expires and discuss with them what the existing rate at that time in the future what the rates will be, and then of course it's up to the customers to make a decision whether to refix again or choose to remain variable. Another question is, can you do a part fixed and a part variable? And this provides you with the comfort knowing that part of your loan is on a fixed rate. You can actually have that peace of mind that that rate will be there for those number of years, so budgeting is easier. And if you have a certain portion of the loan on a variable rate product, you know that you can actually do extra repayments on that variable portion of the loan. You know, if they have extra money, they receive bonuses, tax refund, they can actually put those extra funds into the variable rate portion of the loan. And this, of course, works, is a win-win situation for most of my home loan customers. So if you want us to discuss with you the features of the fixed, the variable, or having a combination of fixed and variable, then please give us a call. You will find our numbers on the screen. My name is Maria Papa. I've been a mortgage broker for the last 11 years. We're a team of women, Filipinas. We want to help all customers of all nationalities to be able to get a home loan, build their wealth, and eventually have a roof on their heads and have happy lives ahead of them.